Hello, clients and friends. This is Ed Skelly from W3 Wealth Management. It's my pleasure to welcome you to our 2025 Mid-Year Economic Review and Tax Law Update. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. Today's agenda is straightforward. First, we will provide a review of equity market performance in the first half of this year. Then we will discuss some strategies and ideas that you can consider for the rest of the year and beyond. And finally, we will share a brief tax law update. I find it is always important to review that there are 5 keys of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is primarily about equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we may make on not just one, but all of these areas for our clients. Let's recap that 2024 was a year that rewarded patient and long-term investors with healthy equity returns. 2025 started out on a strong note, and in February, investors again saw a new all-time high for equity markets. Then volatility started to reemerge. It is not unusual for equity markets to pull back after 2 great years, but what was uncomfortable was the high level of volatility we experienced since February. With the arrival of the new administration came significant changes and uncertainties, which typically affect equity markets. As a result, some of the new administration's policies, stock prices quickly fell into correction territory, and again, volatility increased significantly. If you looked at the S&P 500 on January 1st and did not look again until May 30th, you would see that the equity market had risen slightly, a little less than 1%. No big deal. However, as you examine the day-to-day movements, you find a totally different story. A monthly review of 2025 shows why timing the equity markets and being wrong is dangerous and highly risky. Had you left the equity market in March, you would have missed May, which was one of the best May equity market returns since 1990 and the best monthly returns since November 2023. This is why market timing is dangerous. On April 4th, 2025, the S&P 500 dropped 6%, its worst loss of 2025, in one of the worst days in over 40 years. Then on April 9th, 2025, the S&P 500 rose over 12%, one of the best days in over 40 years. Once again, market timing can be dangerous. Equities are long-term investments, and as this chart illustrates, even with downturns, long-term investors who have stayed in the market over 10, 20, 30, or 40 years were rewarded with considerable gains. Despite market pullbacks, as you can see, stocks have risen considerably over the long term. Volatility is a part of the investment experience. Downturns and corrections are common, and therefore your investment strategy should understand that. Historically, U.S. stocks have experienced, on average, 3 downturns of 5% per year, 1 correction of 10% per year, and 1 correction of about 15% every 3 years. Interest rates remained stable in the first half of 2025. Earlier this year, the Federal Reserve was anticipating 2 rate cuts for 2025. However, due to growing concerns about the current state of the economy, the committee has chosen to take a wait-and-see approach. The Fed is currently forecasting that it will start easing only in December, with possible other rate cuts coming in 2026. The Consumer Price Index is a key statistic used to measure U.S. inflation. It has slowed considerably since its surge to recent highs in 2022. As of May, the year-over-year CPI, otherwise referred to as inflation, was measured at 2.4%. which is slightly higher than April, but overall inflation is still trending in the desired direction. The Fed is so close to its 2% target rate. This was the lowest we have seen since February 2021. However, tariffs levied by President Donald Trump are expected to reignite inflation in the upcoming months, according to economists. For the time being, reports have shown that prices declined for categories such as gasoline, groceries, apparel, used cars, and airline fares during the months of March to April, according to CPI data. The Fed closely tracks core CPI, which excludes food and energy and provides a good indication of where inflation could be heading. For May, the core CPI was the same as April, 2.8%. Currently, we are watching to see how the economy will be affected by tariffs and potential new tax laws. We will monitor how these and other elements have an impact on the consumer price index. For now, we are keeping an eye on the tariff discussions. The US and many other countries, including our biggest trade partner, China, are still debating trade and tariffs. At the time we prepared this workshop, they had agreed to reduce tariffs for 90 days. This resulted in equity markets rising out of correction territory and reducing many analysts' predictions for a recession. Tensions, unrest, and military fighting in the Middle East and between Russia and Ukraine continue to cause uncertainty, which is never a healthy thing for the markets. Equity markets do not like uncertainty, and the current unrest can cause market volatility, so therefore it needs to be watched and monitored. The cost of borrowing remains very high. According to the Federal Reserve reports, the average annual percentage rate, or APR, for cards accruing interest in the first quarter of this year was 21.91%. However, this was down a tick from an average of 22.80% in the last quarter of 2024. For those seeking a new credit card, the interest rate will likely be higher. According to LendingTree data, the average APR range on a new credit card is 20.77 to 27.78%, depending on your creditworthiness. While slowing down, shelter costs are still rising at a pace that is faster than pre-pandemic levels. Rent and home prices rose an average of 3.3% a year prior to the pandemic. The year-over-year shelter index was 4% in April 2025. Shelter costs represent a large portion of the consumer price index and remain a significant factor in overall inflation. The reciprocal tariffs could boost inflation and thus reduce the spending capacity of Americans. Bonds were not exempt from volatility. 2 days after Liberation Day, the 10-year par yield curve rate fell to 4.01% and the 20-year dropped to 4.4%. However, by mid-May, the 10-year par yield curve rate surpassed 4.5% and the 20-year reached 5.03%. Bonds are often seen as a safe haven during times of equity uncertainty and volatility. However, like many things, bond yields remain uncertain. Many factors affect them, including the direction of interest rates and inflation, geopolitical risk, and trade tensions. We use bonds when they are appropriate for portfolios. And when we do, there are several things we take into consideration, including a client's risk tolerance, time horizon, and overall investment goals. Please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against a loss. We will continue to monitor how the Fed's movements and rising interest rates are affecting bond yields. So where do we go from here? Most economists predicted that a market correction, defined as a decline of 10% or more, could happen. And indeed, we saw a correction in the first half of this year. Now, will we see another correction? Could the US experience a recession? A recession is what occurs when an entire economy contracts for several months. Concerns rose significantly after the announcement of President Trump's reciprocal tariffs, which shortly thereafter we experienced the correction. Then, after a 90-day pause in tariffs to China was announced, it rekindled some hope of avoiding a recession in the near future. In late May, JP Morgan Research lowered the probability of a US recession occurring in 2025 to below 50%. Down from 60% previously. This adjustment was based on the temporary easing of trade tensions. Regardless of whether we experience another market correction or even a recession, this is a time for investors to remain vigilant and focus on their personal financial goals. Here are 4 possible ideas to consider if we experience another market downturn. Add new money into your retirement or brokerage account. rebalance your portfolio, convert your traditional IRA to a Roth IRA if you have retirement accounts lower in value, consider strategic tax planning opportunities. If you would like to explore any of these, please call our office and we would be happy to discuss these with you to see if they are a good fit for your unique situation. Here are some things to remember if volatility continues. Turbulence in the stock market can cause concern among novice investors, but seasoned investors understand that volatility is a part of the investment experience. Focus on a long-term, diversified investing strategy that has taken potential volatility into consideration. Focus on time in the market, not timing of the market. Please remember, it is nearly impossible to determine when the perfect time is to get in and out of the market. Trying to time the market can prove to be highly risky, and many investors have missed out on significant gains by doing so. Take advantage of potential opportunities during market downturns. We just discussed a few opportunities that you could utilize during downturns. Before making any decisions, please consult with us to determine if these opportunities are a good fit for your unique situation. Limit exposure to inflationary news and media. As you know, somewhere, somehow, reporting of the facts and data becomes secondary to sensationalizing to keep viewers captivated. And as always, we are here for you to discuss any concerns you have. During uncertain times, for planning purposes, it is wise to have proper financial liquidity. This means that you should make sure you can meet your current and planned short-term and possibly even mid-term financial obligations. You should always strive to minimize or eliminate unnecessary debt, and your focus should be on any upcoming short-term to mid-term obligations. Please let us know if you anticipate needing cash for a large obligation such as funding a wedding, college education, gift, or purchasing a new car. As a recap of the first half of 2025, after seeing 3 consecutive rate cuts in 2024, the Fed is holding rates steady until it sees more favorable indicators. Interest rates remain at 4.25% to 4.5%. While the U.S. experienced a market correction, equities recovered quickly. Volatility remains. We recovered from correction just as fast as it came, but investors should still be cautious. Trade tensions remain, and an uncertainty around new tax laws will be key players in volatility. Staying the course and maintaining the consistency of a well-devised, long-term focused plan has historically served investors well. And last but certainly not least, we are here for you to discuss any concerns you have. Please remember, once again, investing in equities should be viewed as a long-term commitment. The first half of 2025 was a good reminder of why it's a good idea to stay the course, stay invested, and focus on your long-term goals during times of volatility. As mentioned earlier, equities recouped their losses incurred during the short correction we saw. If you pulled out of the market and tried to time a good re-entry point, you could have missed out. We do not recommend trying to time the market like this. Focus on time in the market, not timing the market. We believe that equity investors could have a better potential to meet their goals over long periods of time. And historically, investors with a long-term plan that stayed the course and remained invested were rewarded. We always abide by our equity market mantra of proceed with caution. Having a proactive approach to your financial goals and a solid investment strategy is part of the holistic offerings we provide our clients. While we cannot control financial markets, inflation, or interest rates, we keep a watchful eye on them. We want you to be comfortable knowing that we are staying apprised of any situations that may affect you. Our goal as the stewards of your wealth is to help you through uncertain times like these. We always attempt to help you create a well-crafted plan customized for your unique situation and goals that take into effect considerations how you will react to market ups and downs, including your time horizon, tax implications, liquidity needs, risk tolerance, and your overall personal objectives. If you have any questions about your personal situation, please call our office or tell us at your next meeting. As I record this video, President Trump has just signed the big beautiful bill. We will be recording a separate video after we've had time to review the changes to the tax laws, and we'll highlight those that are most pertinent to our clients. 2025 and 2026 will definitely bring tax law changes, and one of our goals is to keep our clients informed. As I mentioned, sometime in the next few months, we expect to have a strong handle on the actual changes that are coming. For now, we ask that you be aware that changes are coming and to let us monitor the progress. We conclude this workshop where we began, by reminding you that we partner with clients to help them make better decisions. An informed client is our best client. We are very grateful for our clients and appreciate the opportunity to partner with you in your financial journey. Another one of our goals is to help more people just like you. The best compliment is a referral. The majority of our best clients were referred to us by our existing clients. If you know someone you think may benefit from our services, we would appreciate their contact information so we can add them to our distribution list to receive our newsletters, and so we can invite them in for a second opinion. Again, thank you for your business. One of our primary goals is to keep clients informed, and we appreciate you joining us today.